Your retirement income plan can make or break your retirement, let alone have a significant influence on how much confidence and peace you feel along the way. A stable retirement income plan gives you clarity and confidence, while not having one jeopardizes your entire retirement plan. I've got two possible retirement income strategies that may fit for you. Got that and more coming up. Your retirement income plan, your retirement income strategy is one of the most critical components to your overall retirement success. And in this video, I'm going to share two different, very similar, but two different retirement income plans that can really work. And for you, you've got to determine for your unique financial situation, your goals, and how much you have saved up for retirement, your full 5-factor plan, which of these two strategies, or maybe if there's a third or a fourth, is going to make sense for you to have the right retirement income plan so that you have that clarity and confidence in a successful retirement. Now, let me be clear right off the bat. The right retirement income plan does not just satisfy the 4% rule. You might have heard, the 4% rule. It's been around for decades. This is a measure, a sustainable withdrawal kind of formula, okay? Now, this research was done in the 90s. As soon as it was published, there was a lot of debate about it. Well, should it be 4%? Should it be more than that? Should it be a little bit less? Hey, we use the 4% rule not as a rule of thumb, but as, just one of the calculations, but not the determining factor. You need to build out a 5-factor retirement plan, far more comprehensive than a 4% withdrawal rule. A full 5-factor retirement plan based on your unique financial situation, the age when you want to retire, what's your life expectancy, how much you plan on spending, and then, healthcare expenses and taxes and one-time expenses and inflation. What are your retirement income sources? Obviously, the sources of income like Social Security, pension, and real estate income, that's going to feed into your retirement income strategy. How much you have saved up, what's your nest egg, and how much are you saving during your career to reach your retirement goals, and how much investment risk you're comfortable taking with those investment dollars. Those are the 5 factors. There's a lot of sub-factors. I mentioned some of them in between, but that, and then stress tested, Monte Carlo analysis, sorry for the, geek speak there, but that's what's going to determine, are you on track? Not just figuring out, well, what's a 4% withdrawal rate? Can I live on that, right? After you build out that 5-factor retirement plan and you get closer to retirement, you then need to build the retirement income strategy that fits within that 5-factor plan. It combines your retirement income sources, how you're going to optimize Social Security, do you have a pension, what other sources of income do you have, but then also fills the gap of what is the right retirement withdrawal strategy from your overall portfolio. Not a bad idea to stress test, all right, well, is that 4%? Is it a little higher? Is it a little bit lower? But that's not the end all be all. Now, 2 scenarios. There isn't a one size fits all. This is the one way that you have to build out a retirement income strategy. At the same time, it's not limitless either. There's a lot of folks that sort of just wing it and just assume I did a 4% rule, or I haven't even heard of that. I'm just going to withdraw. I've got enough money. I'm just going to withdraw that. Guys, without a structured plan, you might be leaving dollars on the table. You might draw down your portfolio too quickly. Your portfolio may not grow as much as it could out there for your heirs or for your future. And along the way, in addition to all of those potential mistakes, you just won't have the clarity and the confidence that you need. So there's a handful of really helpful retirement income strategies. I want you to have that clarity. I want you to plan ahead. Here are 2 of our favorites built into a case study. The first one we call the personal pension plan. Others may call it a buckets of money approach. We call it personal pension plan because pensions, if you think about it, these are, large sums of dollars that are then structured in a certain way, invested in a certain way, such that they can promise, pinky swear, we'll pay you a certain amount of income for the rest of your life, rain or shine. Well, how can they do that? Those dollars are invested behind the scenes, and yet you just get this paycheck automatically. You don't even worry about it. How can they do that? Well, they structure the pension portfolio in how much money are we going to need to pay out in the short term. Let's get a good return on those dollars, but there shouldn't be a lot of risk and fluctuation. How much money will we need to pay out for this pension in the intermediate term? Let's have a little bit more growth, but not take too much risk just in case the market gets risky. And then what are the dollars that we're not going to have to pay out for several years? Let's be more aggressive, not speculative, but more aggressive with those. The personal pension plan is exactly that as well. It uses math to determine, well, how much do you need to be withdrawing from your portfolio to reach the right retirement income for you? And let's structure 2 to 3 years in a short-term bucket, but still earning some interest. The next 5 to 7 years or so in an intermediate term bucket designed for some growth or some income, but also has some defensive posturing to it as well. And then the dollars that you don't need for 10 plus years, those are the dollars that need to be fighting inflation and growing or outpacing inflation for the future. Diversified long-term investment approach. So the scenario, single retiree, he'd like to spend about $6,000 a month of retirement income. He's got about $800,000 saved up. So a decent amount saved up, but below the psychological $1 million or whatever that people think that they need. Most people think they need more than that, but $800,000 saved up. No other retirement income sources other than Social Security. He plans to retire at 64, and at 64, he's going to do healthcare.gov or so for a year and then get on Medicare. And his Social Security plans on claiming right away. It's going to be around $2,300 a month. So he needs $6,000. Social Security is going to be around $2,300 and therefore needs to have a withdrawal or retirement income to supplement his Social Security around $3,700. $3,700 per month on that $800,000 portfolio. If you just did a 4% withdrawal strategy, you'd say, well, that doesn't work. That's 5.5%. That's too much. No. The 5-factor retirement plan for his situation ended up working. We talked through the risk of, this is a higher amount to withdraw than normal, but he felt very comfortable with that and doesn't plan on leaving a legacy or anything to heirs, is single, like I said, and so comfortable with his 5-factor retirement plan and this withdrawal strategy. So taking a personal pension plan approach of that $800,000, here's how the math breaks down. Approximately taking $125,000 and setting it into the short-term investment bucket, okay? Those dollars aren't taking a lot of risk, but we do want to be intentional about the income that they can earn. So the first, $50,000 or so is in a high yield money market. And then we ladder on a 1 and 2 year CD so that as we distribute, as the $3,700 a month is being sent from that investment account every single month, or maybe that's cut in half and it's sent every couple of weeks or whatever, however it fits and is preferred, that is drawing out of that money market account. And then as that is depleted over the next year, that 1 year CD that is hopefully at a little bit higher of an interest rate and there's less interest rate fluctuation or volatility, that then matures, creates some liquidity that then gets spent through. And then that second CD after that second year, that matures and is available as well. That's how you structure that short-term bucket. Now, in addition to that, about $250,000 is set aside in the intermediate term bucket. Within that, you might continue that laddered approach and maybe find a 3-year fixed interest type of investment, whether that's a CD or a treasury, something, if you can find a competitive yield that will keep up or maybe outpace inflation, that you might want to continue the ladder. But you're also going to invest in some strategies that have a little bit more upside because you want to make sure that you're beating inflation, have the chance to beat inflation, but have some defined downside protection. So these are hedging type strategies that likely build out the rest of this $250,000 portfolio. As things go, right, you're spending through, we're paying out that short-term bucket, and then dollars from that intermediate term bucket are flowing or waterfalling to backfill into that short-term bucket. So at all times, there's 2 to 3 years worth of short-term dollars cash right there so that there's consistent and confidence in that income stream. And therefore, that leaves the rest of the dollars, right? $425,000 or so that really shouldn't be touched for 10 plus years. And in this scenario, that should be then in a diversified long-term investment strategy. Not speculative, but not, 50-50. Likely in an 80-20 type model, maybe a 70-30 type model. So stock heavy, but still diversified in managing risk between US international, large, mid, small, but stocks and bonds as well for this individual investor's comfort level. Love that strategy. Personal pension plan probably makes sense for you, makes sense for most people who work with your CFP, but Scenario number 2, you can still adopt a little bit of a personal pension strategy, but the goals are different, situations different. Married couple, age 65, they'd like to spend about $8,000 a month to live their ideal retirement income. Both will have Social Security. One of the spouses' Social Security is about $3,000 a month, but the other, their Social Security is only about $1,000. So what's best for them is to get half of their spouses. So $3,000 from one spouse, $1,500 from another spouse, $4,500 in Social Security benefit. And again, they only need $8,000. So another $3,500 is what they're going to need to withdraw from their portfolio. Yet, they've got about $2 million saved up in their retirement portfolio. However, their goals are different. They do hope and plan to leave a legacy, and they're hoping intentionally, they do not want to be drawing down these dollars. Therefore, you can do the math and run the numbers on a personal pension plan strategy, because that will work very, very well in this scenario also. But for them, we explored a more creative or different strategy, different approach. While the dividend yield on just the overall stock market is near historic lows, let's just call it 1%. You would need a lot of dollars earning about 1% in order to equal that $3,500 a month that you need. However, thankfully, there are higher dividend options that really don't require speculation. It's still equity income, right? So it's going to have up and downs, but you are targeting investments that have a higher dividend payout, and you can find somewhere between 5 and 6% if you're careful. You don't want to be too risky, but it is going to be stocks, so there is going to go up and down. And if you're able to find a dividend and equity income strategy that on average pays about 5%, then in this scenario, out of the $2 million, we could take about $900,000 and put it in an equity income model. And when things are going well, that $900,000 should be able to kick off enough income to provide for that stable monthly income. And that $900,000 should hopefully, because it's equity income, have some appreciation potential as well. If that $900,000 out of the $2 million is enough to meet their income need through dividends, that's fantastic. You then use the remaining 1.2 to build around that, to build structure around that equity income model to manage risk. We're taking about $100,000 and putting that in, CDs or money markets, something earning fixed income, just in case they have an income need above and beyond, or a cash need above and beyond that monthly income. So we've got that there, just in case that's needed. But then we build around that, likely with the remaining million, with hedging strategies, right? Because what's at risk with that equity income? Well, what if equities drop significantly, right? Maybe that yield rallies, but maybe that yield then gets cut. And so you want to have some hedging as a decent position within that portfolio. And then the rest of it, right? If their goals are leaving a legacy and building wealth over generations to come, investing it, not speculatively, but still for the long term. That builds structure around that equity income piece, reaches their retirement income strategy goals and their long-term goals of continuing to build wealth in retirement. The point is, there isn't a one-size-fits-all retirement income strategy, but you do need to have the structure built out for your unique financial situation. Build out that 5-factor retirement plan so that you have confidence that you're on track for retirement, but then go the next step of crafting the right retirement income strategy for your situation, whether that's personal pension plan, whether it leverages dividends, whether there's another approach that makes sense for your situation. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.